thought you understood was actually a stage built on invisible gears markets humming under your feet. Algorithms predicting your behavior before you even make a decision. And an entire financial system silently placing bets on your future, without ever asking your permission. That's the strange truth about money in 2025. Most of us live inside a machine we didn't design, can't fully see, and barely get a chance to influence. But every day it shapes what we pay for food, how much our jobs are worth, whether our rent goes up, and how safe our savings really are. Finance was supposed to be a simple tool, something humans created to build, trade, and grow. Somewhere along the way, it learned to think for itself. It learned to manipulate. It learned to extract more than it gave. And today, the machine is louder than ever. It didn't start this way. For most of history, finance was about real things. Fields, tools, ships, grain. People saved money to build farms, fund voyages, open shops. Value flowed from the physical world. Then came the Great Acceleration, derivatives, modern banking, algorithmic trading, sovereign debt markets, shadow banking, and the rise of institutions so large they can tilt entire economies with a single decision. And somewhere between the 1980s and the 2008 crash, finance stopped being the quiet engine behind the economy and became the star of the show. Today, the financial sector in many countries makes up between 20% and 25% of GDP, far larger than manufacturing or tech. On Wall Street, high-frequency traders compete using fiber optic cables laid in perfectly straight lines just to shave off microseconds. Hedge funds use satellite imagery to predict crop yields before governments even release the data. Private equity firms buy companies, load them with debt, strip cash out, and walk away before the workers even realize what happened. And ordinary people are left wondering why everything feels more expensive, more unstable, more precarious. Because this machine does not simply move money, it moves risk, it moves pain, it moves dreams. And it always makes sure someone pays. If you zoom in closely enough, you'll see something uncomfortable. The system isn't designed to create value anymore, it's designed to extract it. In 2025, global debt levels have reached all-time highs. Corporate leverage is rising faster than profits. Governments borrow more every year, hoping tomorrow will be cheaper than today. And individuals caught in the middle are pressured to invest, speculate, hustle, flip, trade, and constantly manage risk they never asked to hold. Somewhere in the last decade, living became a financial strategy. Savings became positioning, dreams became exposure, and security became a privilege instead of a right. But the real story starts with trust, because when trust breaks, the whole machine shakes. In 2008, the world learned that the people selling financial products didn't always understand them. By 2020, during the pandemic stimulus era, people realized governments could print trillions with a keystroke. By 2023, after waves of inflation, everyone understood that money doesn't store value, it stores belief. And by 2025, after bank collapses, crypto implosions, sovereign debt scares, and constant market manipulation scandals, that belief is fragile. This fragility is what gives volatility its power. It's why markets move violently on rumors. Why currencies swing on a single speech. Why cryptocurrencies can soar on memes and collapse when regulators send a letter. When trust dies, speculation thrives. Speculation is not just a bug, it's the operating system. Every major market now lives on forward expectations. Stocks trade on future earnings. Bonds trade on future interest rates. Housing prices trade on future demand. Even eggs, wheat, lithium, and shipping containers trade on futures markets. We're living in a world where the present barely matters, everything is a bet on the next headline. Finance became a time machine that tries to monetize tomorrow before it even arrives. And the people who understand this system make fortunes. The people who don't get crushed by it. Look closer and you'll see how uneven the game really is. The top 1% now hold nearly half of the world's wealth. Hedge funds and asset managers handle trillions, using strategies built with PhDs, supercomputers, and machine learning systems that react in milliseconds. Meanwhile, the average person tries to save for a home while competing against institutional buyers paying cash. They try to invest for retirement while trading firms execute thousands of transactions per second. They try to build stability while the system quietly charges fees, interest, penalties, spreads, and margins so small they're invisible, but multiplied billions of times, they become empires. This isn't accidental, it's the design. When you use your credit card, banks earn interest. When you send money abroad, payment networks take a cut. When you invest in an index fund, asset managers earn management fees. When you take out a mortgage, lenders package it, sell it, repackage it, insure it, trade it, and profit from every step. Finance has turned human needs into financial products. Homes, retirement, education, transportation, even healthcare. Everything is collateral. Everything is securitized. Everything is a revenue stream. And yet the machine is not invincible. It breaks, it leaks, it exposes its wiring. In 2025, new regulations, antitrust cases, monetary tightening, and geopolitical shocks have pushed markets into a strange era one where the system is too complex to predict and too critical to fail. Governments intervene constantly. Central banks flip from tightening to easing. Tech giants enter finance and instantly rewrite the rules. Crypto, stablecoins, and digital currencies challenge traditional money even as they introduce their own crises. The world is caught between two systems, the old one built on centralized control, banks, and regulation, and a new one built on code, decentralization, and distrust. Both promise stability, both create volatility. The truth is, finance today behaves more like weather than science storm systems forming offshore. Pressure building in unexpected places, tsunamis of capital moving across borders, and sudden lightning strikes in markets that seemed calm a moment earlier. And just like weather, most people only notice it when they're getting soaked, when rent spikes, when a bank tightens lending, when groceries cost 20% more, when investments fall, when their currency buys less this month than it did last month. You feel the storm even if you never asked to be in it. But here's the twist. Despite the chaos, finance remains the most powerful tool humans have ever built. It can build nations, cure diseases, fund innovation, end poverty. Japan rebuilt itself through financial discipline. South Korea became a tech superpower by deliberately channeling capital into its industries. Singapore turned from a swamp into a global financial hub. Finance is neither good nor bad, it reflects the people who use it. When used to build, it lifts entire civilizations. When used to extract, it hollows them out. That's the real conflict of our era. Creation versus extraction. Investment versus speculation. Abundance versus scarcity. Transparency versus illusion. Every government, every corporation, every household is balancing on this line, trying to survive in a system where the rules shift constantly. The winners aren't the richest. They're the ones who understand the machine well enough to move with it instead of getting consumed by it. And yet something remarkable is happening. For the first time in decades, people are paying attention. Ordinary citizens are reading balance sheets. Teenagers are discussing interest rates on TikTok. Activists are tracking political donations. Investors are demanding transparency. Regulators are waking up to the dangers of monopoly power and algorithmic manipulation. The machine is still powerful, but its walls are cracking and light is leaking in. If this fascinates you, if you want to understand the real power structure,
in pulses, surging, sinking, rising again. The world's oldest asset is behaving like it's alive, moving with every political headline, every rate cut rumor, every whisper of war. One day it's racing upward, the next it's dipping sharply, leaving traders dizzy. What's driving this chaos? A storm of trade tensions, economic anxiety, and central bank decisions, all colliding at once. The result isn't just a price rally, it's a global mood swing, written in gold. Gold doesn't pay interest, it doesn't innovate, it doesn't change. Yet it keeps pulling the world attention because it represents something modern. Money doesn't. Permanence. When everything else feels unstable, people run back to the metal that's outlived empires. But lately, even gold isn't steady. It's volatile, unpredictable, and emotional, reacting to every move made by markets and governments. This isn't a simple boom. It's a tug-of-war between fear and hope, between what investors believe and what they're scared to admit. So why now? Why this sudden burst of energy from a metal that usually moves like a glacier? The story starts with the world's growing unease. Inflation might be cooling, but growth is too. Trade routes are tangled. Technology wars are spreading. Currencies are swinging like pendulums. All of it adds up to one thing: uncertainty. In uncertain times, gold becomes a kind of global insurance policy. It doesn't rely on earnings reports or policy speeches. It just sits there, holding value when trust erodes. Central banks, especially in Asia and the Middle East, have been quietly buying it for years. Those steady inflows built the floor under prices long before this rally even began. But once the headlines turned darker, once trade wars resurfaced and economies showed cracks, the quiet flow of money turned into a rush. Investors moved funds out of risk assets and into anything that felt safe: bonds, the dollar, and above all, gold. And that's when the mood flipped from calm accumulation to panic buying. The new trade war rumors poured gasoline on the fire. The latest round of US-China friction sent shockwaves through global supply chains. Companies feared shortages. Markets feared tariffs. Consumers feared prices rising again. Fear, as it often does, made people look for something that wouldn't break. But here's the twist. In this cycle, fear doesn't move in one direction. It ricochets. Every new statement, every trade threat, every temporary truce causes gold to jump or tumble. It's no longer just a safe haven. It's a mood barometer. It reacts not to what is happening, but to what people think might happen next. During trade standoffs, currencies often get pulled into the chaos. Each side tries to weaken its money to make exports cheaper. That ends up weakening confidence in currencies themselves. And when paper weakens, gold strengthens. Even if the metal stays the same, its reflection in money looks brighter. The fear doesn't stop with trade. There's another player in the game: the Federal Reserve. Every signal of a potential rate cut sends tremors through markets. The logic is simple. When interest rates fall, gold wins. Because suddenly, the cost of holding a non-yielding asset disappears. If savings and bonds pay next to nothing, gold looks like a smarter store of value. Investors have already priced in multiple cuts. Some expect them sooner rather than later. And every time the central bank hints that cuts are coming, gold jolts upward. Every time they hesitate, it dips again. The metal now moves in rhythm with the Federal Reserve's tone of voice. But there's another reason this rally feels different: speed. In the past, gold moved slowly, reacting to real-world shifts. Now it reacts to sentiment. Social media amplifies rumors in minutes. Algorithms trade headlines before humans even read them. That speed creates volatility. It makes every move sharper, every correction deeper. This is why gold, the symbol of stability, has turned volatile. It's caught between human fear and machine precision. Day traders ride its spikes. Long-term investors clutch it tighter. Everyone else just watches, wondering what the next headline will bring. Some analysts warn that the market looks stretched. Charts show overbought signals. Momentum funds and ETFs have poured in record cash. But these same analysts admit something else. It's hard to bet against fear. As long as uncertainty rules, gold has fuel. And fear is one resource the world never seems to run out of. Physical markets are also showing the strain. In Asia, refiners report longer delivery times. Premiums on gold bars are rising as demand outpaces supply. But the same traders warn that it's a fragile balance. If global sentiment turns brighter, even briefly, that demand could vanish overnight. It's a strange paradox. Gold rises because people fear crisis. But that rise itself can create new risks. Once prices move too high, fast money piles in, and when those traders cash out, they can cause sharp collapses. In recent weeks, wild intraday swings have left even veteran traders breathless. Some days, gold behaves more like tech stocks than a safe haven. That's the irony. The asset that's supposed to calm nerves is now the one